Hi class, welcome back to Financial Accounting. I'm Matt Fisher, your accounting professor. In the previous video, we went over investments for debt type transactions, for debt investments. In this video, we're going to continue the discussion, but now we're going to look at equity. We're going to be looking at purchasing stock of another company, in particular voting stock of another company, and how we account for it. Well, basically there are three ways that we account for equity investments. So if we buy stock, voting stock in another company, there are three ways that we can account for it. The first way that we can account for it is if we have insignificant influence. That's an important term. We call it insignificant influence. And this means that the purchaser of the voting stock is purchasing less than 20% of that stock. So they have less than 20% of the stock in their portfolio. So then they have insignificant influence over the dealings in that corporation that they're purchasing, okay? When you have insignificant influence, we just record this at its fair value. Whatever price we paid for it, less any sort of transaction costs, would be our price that we would have on our balance sheet for this investment. We would recognize any dividends as dividend revenue. So any dividends we receive would be dividend revenue. At the end of the period, at the end of that year or period that we're looking at, any unrealized gains or losses need to be looked into, okay? Now remember in our previous video, we had that fair value adjustment account. Well, we have that same account for insignificant influence. So let's say at the beginning of the year, our portfolio was 20,000. And at the end of the year, our portfolio was 23,000. So the portfolio increased $3,000. So in our journal entry, we would debit fair value adjustment dash, we're just gonna say stock because it is stock. The other methods that you'll see in just a minute don't use a fair value adjustment account. Only the insignificant influence one does. So anyway, we would debit fair value adjustment dash stock, $3,000, and we would credit unrealized gain dash income because it would be recorded on the income statement, and we would credit that $3,000. This fair value adjustment account that we debited $3,000 is an asset account. It's going to go with this portfolio. Okay, it's going to go with this portfolio of insignificant influence, and it's going to, in this case, increase that portfolio by the $3,000. Okay, so it is on our balance sheet. And then just like with the available for sale and trading from the previous video, when we sell these insignificant influence voting stock, we don't look at the fair value adjustment account. When we sell it, we just look at our original cost and our sales price less any fees. And that's how we would calculate any gain or loss on the sale of insignificant influence investments. All right, so that's insignificant influence. The next one is significant influence. And this is when the purchaser, the company or the purchaser, when they have between 20 and 50% of the voting stock of the company, they'll record this using the equity method, okay? Which basically is there's no fair value adjustment. The business would increase in investments based off of the share of earnings that this company had. The business would decrease the investment by the shares of any of the dividends that they received, okay? So this is really an upper division type topic, all right? I just wanted to introduce that significant influence method is important. You do need to understand just in general what that is. It's between 20 and 50% of the voting stock. But it really is an upper division type concept because you have to go over the equity method. Then the last method is controlling influence. Controlling influence means that the purchaser has more than 50% of the voting stock. So they have a controlling interest, meaning basically they own the company because they can vote on anything they want because they control it, right? In controlling influence, we use the consolidation method to account for it. We do not use a fair value adjustment account, it's the consolidation method. And just like before, this is an upper division accounting type concept that you'll go over in upper division accounting classes. No need to know any more than that right now for this class. All right, class, I hope this video has helped. I hope to see you again in future videos. Good luck, class.